Forecast for gold this year is about up to 2,500. And so then I took the gold silver ratio back to like 70, and that put silver over 30, which will be a big achievement. So I'm still bullish. I do think that, again, when the run to gold happens and then the sprint to silver takes place, we'll be in a position where you can't get it, probably. But we could be in what we've already seen, where you got to wait 3 weeks to get it, or 4 weeks, or whatever. It's going to be, I think, the biggest lesson that we already know it's ahead of us, and that's that all fiat fails. That doesn't mean it goes to absolute zero, but the perception is it's going out.
In the current market scenario, precious metals, including silver, are experiencing depreciation attributed to the resurgence of the US dollar. A broader perspective reveals a trading pattern resembling a falling triangle, with bearish sentiments honing in on the critical $22.50 support level. In Tuesday's session, gold exhibited a notable downward trend, hovering around the $2,025 mark. The resilience of the U.S. economy is exerting downward pressure on precious metals. However, the downside is limited as long as dovish expectations regarding the Federal Reserve persist. Renowned analyst DavidMorgan from the Morgan Report is optimistic, forecasting gold to reach $2,500 this year. He suggests that silver, currently facing downward pressure, is expected to surpass $30. The recent turbulence in U.S. interest rates has left its mark on gold prices, with hedge funds opting to liquidate their bullish positions. The latest trade data from the Commodity Futures Trading Commission reveals this cautious stance among investors, as they remain hesitant to commit to substantial bearish bets. Analysts, including prominent figure DavidMorgan, maintain an optimistic outlook in the face of potential market interventions. Morgan points to the enduring positive sentiment, particularly during heightened demand, such as a rush to buy gold and a subsequent sprint to acquire silver. Morgan highlights the influence of inflation on market dynamics. Despite a discouraging consumer price index reading, which hit a 40-year high of 9.1% in June 2022, recent months have seen a moderation in inflation, supported by elevated interest rates and declining energy prices. Morgan emphasizes the diminishing relevance of specific price numbers. The lack of trust in currency values poses challenges to accurately predicting the value of assets. Join us as we delve into insights shared by DavidMorgan. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
In 1979, January, the all-time high for silver was roughly $6 an ounce. A year later, it was up under 850% at 50. Okay.
Yeah.
Here's the point. It dropped from 850, but it averaged $20 an ounce for all of 1980. So 79, the all-time spike high was at 6. A year later, the average price for the year was 3 times higher. That's a structural change you just outlined, and that did take place, which very few people think about. So it'd be the equivalent of silver going to something like 150, coming back down to, say, 50, and staying at 50, and basically that's the floor for a very long time. So yeah, so now Elon's got to deal with $50 silver, not 25, or maybe $75 silver. Yeah. Numbers are almost irrelevant because in a inflationary / hyperinflationary environment, there's so much distrust in what the currency's value is that you really can't put a number on it very accurately. We could talk today so you get a general idea, but if you wanted to buy a Coke in Zimbabwe at the end of the hyperinflation, it was only $50 billion, and then by the time you went to dinner, it was 100 billion zims. So I always forecast gold. It's a lot easier to analyze.
Yeah.
So forecast for gold this year is about up to 2,500. And so then I took the gold silver ratio back to like 70, and that put silver over 30, which will be a big achievement. I think there's some buddies out there that are really defending that $30 level. We saw that already with Mr. Benham coming out and saying they had to tamp down the silver market. Why would anybody that worked for the CFTC say they have to tamp down the silver market? But they're so blatant, Yeah. So I'm still bullish. I do think that, again, when the run to gold happens and then the sprint to silver takes place, we'll be in a position where you can't get it, probably. but we could be in what we've already seen where you got to wait 3 weeks to get it
Mm.
or 4 weeks or whatever. It's going to be, I think, the biggest lesson that we already know it's ahead of us, and that's that all fiat fails. That doesn't mean it goes to absolute zero, but the perception is it's going out. I think it's good, except, the only thing I would add to it is, how much printing has gone on between 2008 and 2023 for me.
Yeah.
I mean, it's unbelievable. I mean, we're in a parabolic mode of velocity of money going to like new lows and the amount printed to new highs. And so there's that discrepancy. Well, how does this work? And how it works is, if you think about it, one is people that, the average person out there is barely making it, if they're making it at all, some even with 2 jobs. They can't afford groceries, the gas bill, the light bill, and the fuel for the car. And then on the other end, you've got all this funding money floating around the asset markets or being parked. And I think that's the big one. I'll shout out to Tavi Costa, I think you say his last name. And, he pointed out, and I think the number is even bigger, but it was like 5 trillion sitting there basically in the money markets on the sidelines. And I said, well, wait a minute, if we take 1% of that, we're looking at 50 billion. That's 1%. Well, what's the silver market, Craig? 25 billion. So 1% of that money sitting on the sidelines is 2 years silver production and recycling. If you don't think 1% of that money is going to move into the silver market during the next crisis, then I got a bridge to sell. So we have, I think, a bright future. Not that as far as our silver position, it's not a bright future. I mean, I'm not sitting here jumping up and down. It's going to be different than in 1980, because there you could have changed your lifestyle, bought a business, retired early, whatever. This time, there's going to be a lot of people struggling. There's going to be a lot of people that are going to learn the biggest lessons of history. Yeah. What's the greatest lesson of history? People don't learn the lessons of history.
Right.
That's the greatest lesson.
Morgan sheds light on the delicate balance the Federal Reserve faces when communicating about inflation. Despite the Fed's assurances that inflation is under control, Morgan warns that convincing them of low inflation becomes challenging once people start feeling the impact of rising prices. In recent developments, U.S. prices experienced a rare decline in November, marking the first time in over 3.5 years. This shift has pushed the annual inflation rate further below 3% and fueled expectations in financial markets of a potential interest rate cut from the Federal Reserve in the coming months, possibly as early as March. The Commerce Department's recent report, released on Friday, highlighted the drop in prices and revealed a continued easing of underlying inflation pressures. This cooling inflation trend has had a positive effect, leaving households with more disposable income. However, Morgan expresses skepticism, especially when considering the global economy's complexities. The psychological impact of inflation, he argues, has the potential to spiral out of control. This could pose a significant challenge for the Federal Reserve in maintaining a narrative that aligns with their reassurances of inflation being under control. Let's get back to the interview.
I think one thing that most don't touch on, and of course, again, I learned from experience and Mr. Dines and others, the psychology of the market. So what does the Fed really do? Well, of course, they manipulate the money supply and they set the discount window at the Fed and all that. What do they really do? They do a psychological, mindset for the public. Everything's fine. Everything's good. We're not going to see a recession. We're going to have a soft landing. So they're using psychology. Well, let's look at the other side of the coin for a minute. What's the reverse psychology of them? It's the inflation psychology that nobody ever talks about. So the idea that, we're going to get inflation down to 2% and we're going to, be able to lower interest rates. What if the psychology goes, screw these guys, they've lied to us about everything. And inflation isn't going down because the last time I bought peanut butter, it was up another 80 cents for, 6-ounce jar. And once you get to the psychology of inflation, it's almost impossible to break it.
Right.
And I know because I lived through it. Because when I was, in my 20s, and we kept seeing more and more inflation. I mean, I went and got a signature loan just to buy gold because it was a no-brainer. I borrowed money at like 8%. That's like 8%. How could you survive? Hell, that was low. That was low because inflation was 13. So we were 5% underneath the true inflation rate. So you're getting free money. It's all relative. Yeah. And then, of course, with Volcker coming in, he had what it took to take the markets back to some sanity. I'm not so sure we can do that this time. So once the psychological factor of inflation comes in, they might be jumping up and down and telling us a bunch more lies. I mean, the Ministry of Truth comes out and Grandma Yellen, God bless her, comes out and tells us everything's fine. And it's ridiculously ridiculous. And so that's the way I see it, Craig. I think that it may be harder for them to do what they think they can do versus the reality because things can get out of their control. Most people have never experienced that, but I have. And it could happen again, except this time it's not just the US of A, it's basically it's the world, and the only counter policy to it pretty much is the BRICS. But even they can't mitigate it total perform on that basis. But if you're a good stock picker, my top tier picks, both in silver and in gold royalties, both of them, one's a streamer, one's a royalty company. From the peak of gold at 2011, one's triple. So that's better than what gold's done because it's made a round trip, 2000 to 2000. And silver from 50 down to 25, still that stock is double. So, and these are big plays. These are put big, serious money. So if you pick the stocks right and you have some patience, you can do better on the equity side. But it's not everybody that can do that. I'm not trying to brag because I've sure got my I've got a bunch of wallpaper, as we say, with the juniors that have gone nowhere except to zero. And so,
As gold maintains its position around the $2,000 mark, following a nominal peak of $2,152 in December, experts worldwide share their predictions for the precious metal landscape in 2024. Investing Haven, a notable source, has weighed in on the silver outlook, forecasting a price of $34.70 for the metal in the coming year. What are your upcoming price targets? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.